Hi, I am Maribel Gonzalez David, Realtor with Windermere. Today I have here Dave with me and we will talk about loans. Hi Dave, thank you for being here
I'm happy to.
today. Thank you.
Thanks.
Can you tell us a little bit about yourself?
Sure. Yeah, I've been doing loans in the Portland area for about 25 years, 26 years, something like that. And I started out over in Northeast Portland, working in some of the areas over there when home prices were quite low in that area. And I've gone through the era of subprime and all the other things that have happened in the last 20 years and still enjoying what I do.
Excellent, that's great. Then that's very important.
Yeah, it is.
Okay, let's jump into our questions and answers. You ready?
I'm ready.
Perfect. What should buyers do before applying for a loan?
Well, I think the biggest thing that buyers can do to get prepared to buy a house is probably most importantly is keep their credit on payments on time and make sure that they don't have any late payments, especially in the year leading up to the time they want to get a mortgage, because that's the most important time for credit scores to be improved, or in some cases to go down. So we want to make sure they're doing that. Be prepared that we're going to ask for a fair number of documents from you. So if you're applying, and typically it's just income documents with W-2s and pay stubs, that kind of stuff, and some bank statements. So for us, it's really more of just being able to get the things we need to get your loan approved and ready to go. And the sooner we get that, the better.
Perfect. And how do you help pick the right loan?
Well, everyone is as many different people are out there as many different cases of unique circumstances that people have. Everybody is a little bit different. Some people have great credit and a low down payment. Other people have moderate credit and not much down or a high down payment. And some people have a lot of assets that we can use to help qualify them for a loan. So it really depends on a number of factors with somebody. There is no one right loan. There's no best loan out there. If you're a veteran, you can get a VA loan, and those are typically, probably for most veterans the best way to go. But other than that, we have to get your information and get the application going so we know what loan program to put you in, because sometimes we just don't know until we get all the information we need. And honestly, a lot of people don't really know what coming in, what the situation, what it takes to qualify. There's just a lot of people come into this. excuse me. A lot of people come into this with not knowing much about it at all. So my job and our job is to help educate them on that, figure out what's going to work for them the best. Some loan programs have better rates, some have lower payments, and some are no down payment. So we're going to look at all that before we make a decision together with our clients on what can be the best loan program.
Excellent. And what affects interest rates most?
Yeah, that's a great question, and it's a little bit of a loaded question right now. The two things that affect where mortgage rates are the most is going to be unemployment news and how the economy is doing, and inflation. We watch those things closely, and certainly the investors who are buying mortgage-backed securities and who are involved in this industry are watching that closely. So we've been in a period of kind of flux when it comes to those things now. So we haven't seen rates really change a lot in the last couple of years, but we anticipate when things settle down a little bit, we're going to start seeing rates come back down. We're just not sure when that's going to be at this point.
Excellent. Okay. Let's jump to the next question. Pre-qualification versus pre-approval. What are the differences?
Yeah, those terms historically have been a little bit intermixed, and some people say they've got a pre-qualification and some say they have a pre-approval, and sometimes it's the same thing. But technically a pre-qualification doesn't go through all of the motions of getting the approval done. So a pre-approval is normally going to be a stronger, more in-depth approval that we give to people. We typically try to do a pre-approval with everybody who we know is going to be out shopping or is active in the process. Sometimes somebody will come to us and just want to get a basic idea what it's going to take to get approved and where they're going to have what steps they're going to need to take. So we might do a pre-qualification in those cases, but for the typical buyer, typical person applying for a loan, we're going to do a pre-approval because the last thing in the world we want to do is send somebody out shopping for a home only to find out after they fall in love with the house that they can't get it. So it's really important, and it's a little bit more of a process for the buyers when they're going through this, and but in the end, it's well worth to go to the pre-approval stage.
Yes.
Yeah.
You're completely right. Bigger mistakes that delay approval.
By far is not getting us the information we need, which sometimes is not easy for people to get. Sometimes we're asking for trust documents or things like that might be a little bit trickier for them to get their hands on. But if we don't have those documents and they come in late and they're not as we expected, then we sometimes have to adjust the process, and that can cause delays. Sometimes we'll have an appraisal delay, so depending on the type of property. And oftentimes people have want to get some adjustments done on the contract. Maybe they want to get some repairs done or want to get the seller to pay for some things, and those have to be renegotiated sometimes. So a lot of times the process itself will cause a delay. Our goal is to get the approval done as fast as we can so we can keep things moving forward. So when we run into those potential delays, we're ready for them, and we can hopefully adjust the time factor as little as possible and get them closed as soon as we can. On a normal transaction, we shouldn't have delays. We should be able to close on time. We know the close date from the very beginning, and that's our goal.
Excellent.
Yeah.
That's great. I think that's very important.
Yeah.
That's good. Credit score. How much does it matter? You say it's very important.
Yeah.
And a minimum to qualify for a loan.
So the thing that it's surprisingly easy to qualify for a mortgage, credit score wise. We go down sometimes in the 500s is the middle score that we'll use. The middle score of the 3 bureaus is what we use. But the big advantage to having better credit is you're going to get a better rate and less fees, less points to get that loan. So oftentimes people can qualify, but the program they get is not going to be as good as someone. The terms that they get are not going to be as good as someone who has good or excellent credit. So our goal from the beginning is not to completely change somebody. It's to see what potential credit improvements we can make when they apply, and hopefully do some of those factors that might just inch their score up, sometimes a lot, sometimes a little, to that next level where they get just a little bit better price or a little bit lower fees to get the loan done. So, but credit is also one of those things that most people don't understand very well, don't understand how their score is derived. So I'm always happy, and my team is always happy to talk over with them what it is that's in their score, what we can do or what they can do differently, and kind of help them improve their score over time. And if we're ready to go and they want to get approved right away, sometimes there's some quick things we can do to improve their score over the short term as well.
Excellent.
Yeah.
That's good news.
Thanks.
Okay, let's go with the next question. How can buyers boost their credit score? That's the question.
Well, it's there's a couple things that are the strongest factor in credit scores. The first one, of course, is pay your bills on time, right? Pay your credit. If you have credit, make sure that payment is less than 30 days late. So if you're 1 day late, if your credit card is due on the 10th and you pay it on the 11th, it's not going to hurt your credit score. You have 30 days from the due date before it's recorded as late. But on the 30th day, it will record late and it will affect your score. So, and most people don't necessarily realize they have a grace period. Just be aware of that 30-day late period, so you don't go over that. The other one is most people that have on-time payments, the biggest detriment, the biggest lowering of their score comes with revolving credit, which means the balance revolves. Typically, we think of credit cards, sometimes store cards. Any account where the balance goes up and down, you can basically charge on it and bring the balance up. We care much more about the amount of credit that you're using toward the limit. So if you have a credit limit of $2,000 and you have a $1,990 balance on that, it's going to have a negative effect on your score. As soon as you pay it down and get it hopefully within 25% of the allowable credits, you're going to see that score go up right away. There's no delay on it. It reports once a month, and every month it recalculates that. So there's no penalty for having a high balance today and paying that down and having your credit go up. So those two things are by far the things that people can control the most. Once you get an installment loan, such as a car payment or a student loan, all you do is make those on time, and they don't really have a negative effect on your credit unless you're, again, 30 days late on those. But that's by far the two credit things that people can monitor and do. And we're happy to help once we run credit reports, help you figure those things out and figure out how much you can benefit, how much your score can benefit, things like that. So
How to boost it.
how to boost it, yeah. Perfect. Yeah.
Okay. Okay. The next question. Who qualifies for down payment help?
So down payment assistance is almost always based on the household income that the applicants have. Sometimes it can be just the applicant itself, sometimes it's the whole household income regardless. So the government has typical income figures for each census area and if you're at the 100% or less of that average income for that area, oftentimes you're eligible for some down payment assistance that other people might not be eligible for. And some of those programs are real simple. Some of them you have to jump through a few hoops to get that down payment assistance. Honestly, there are a couple of programs where they're not income based at all, and you can still get 100% financing. But realize if you're doing 100% financing, your rate is probably going to be a little bit higher than if you had a down payment, simply because the risk to the bank is higher, and so they're going to charge you a little bit higher interest rate if you're not coming in with little or no down payment. But there's a lot of programs with low down payment out there. FHA is 3.5%. There are some conventional loans that are only 3%. So oftentimes people can save that or get a gift from a family member to help get to that number. And those programs oftentimes are going to have better rates and lower payments than some of the ones where they're getting down payment assistance. So again, that goes back to your question about what the right program is. We have to determine that when somebody comes in, what they're eligible for and what they may or may not want to do as far as the payments go. So,
Perfect.
yeah.
Perfect. Okay. Adjustable versus fixed rate difference.
Yeah, so think of an adjustable rate as it's a 30-year rate or a 30-year loan, but the rate is only going to be fixed or is going to be guaranteed for a certain period of time, and those are typically 3, 5, 7, or 10 years. We don't do a ton of adjustable loans right now because the market isn't very favorable for adjustable loans, and oftentimes the rate is close to what the 30-year fixed rate is. And for most people, why take a chance on a shorter term loan if you can get virtually the same deal on a 30-year fixed? So when the market starts getting a little bit lower and we see the bond market changing, we probably will see the adjustable loans start coming back much more than they are now. And they make a lot of sense for the right buyer. But my advice on adjustable loans is make sure you know what you're getting into, how long the term is, what the rate could possibly jump to once that 3, 5, 7, or 10-year period is up, so you know to be able to plan for that. And if you can't, if that's not something that's doable, then don't do an adjustable rate loan. Or if you're going to be selling the property within a fixed period of time, if you know you're only going to be in a house for 3 or 5 years or 7 years, then oftentimes those might make sense. But I always warn people you have to be very sure before you do that, because we don't want your payment jumping up if rates go back up after that period is up. So caution, they can be a great program, but caution is definitely the word on adjustable rate mortgages.
Okay. About closing costs, typical closing costs.
So in Oregon, the property taxes are only collected once a year, and so with closing costs, oftentimes the biggest cost is the prepaid property taxes, and of course homeowners insurance has gone up dramatically in cost over the last couple of years as well. So oftentimes half of the closing costs or more are just the property taxes and insurance. The actual cost of doing a loan, the mortgage, there's quite a few different things that go into what that cost is. There's title policy, title insurance, there's appraisals, there's oftentimes like in Washington County, there's a tax that has to be paid between the seller and buyer. So there's a number of things that go into that figure, and it can vary dramatically from one property to the next. So my advice on closing costs is if you're shopping for a home, make sure you're paying attention to the property taxes for that home. It's going to affect both your closing costs and your monthly payment based on us collecting every month part of your taxes. So when they become due again, that we have enough in there to pay them. So it sounds complicated. It's not that complicated, but it's one of those things that we want everyone to be aware of. If you're in Washington, it's twice a year, so the prepaid taxes aren't as much in the state of Washington. But in Oregon, it's always about the same. And by the way, it doesn't really make much difference what time of year you close. The prepaid taxes and insurance are going to be roughly the same. So I would not advise anybody to wait to buy just because they think they'll get lower taxes up front because you loans. So that's pretty consistent. But other than that, that's really what closing costs are. Yeah.
Okay. Top tip for buyers in the next 6 months.
Well, probably the best thing I can tell people is when rates are up like they are now, the number of buyers in the market is dramatically less than it will be when rates go down. And a lot of that is quite a few people can't afford to buy at the higher rate because the payment is just too high. But when the payment goes down, some they might be able to qualify or might be comfortable making that payment. The other issue is a whole lot of people that have rates from the COVID era are at high 2s or low 3 interest rates, and they're not ready to trade up yet on a house. So they're kind of waiting to get their next house, their move-up house, until when the rates go down too. So by almost all accounts, we expect the number of buyers to jump as soon as we start seeing rates come down, and whether that's going to be in the next 6 months or not, it's hard to say. But once that happens, we're almost certainly going to see more competition for homes, more people eligible to buy the same home than we have now. And competition creates price movement, and typically we'll see housing prices go up as the demand goes up, as competition goes up. So if you're looking for a great deal on a house, or even a good deal on a house, you're probably better off to think about buying before the mass hits. Otherwise, you're going to be in there, kind of shoving elbows with everybody else that's looking for that same house at the same time. Because one thing about mortgage rates is nearly everybody who has high rates and qualifies well is going to refinance when the rates go down. So it's a good time to, we also have some temporary buy downs that are available where people can get a lower rate for the first couple of years just to help out, to keep that payment down until it becomes time to refinance. And those can be a great deal with very low risk to the buyers. So I'm always happy to talk to people about those too, and if that situation fits what they want. But probably be aware overall for the next 6 months, just be aware that pricing is as high as it seems right now. It's likely going to go higher once we see rates come down.
Excellent. Okay. Any new changes to benefit buyers?
Well, I'd say the biggest change to benefit buyers, other than interest rates going down, hopefully, will be there are some new tax advantages with the new tax laws that just came into effect. They'll be much more deductible for lots of people on their taxes, on their federal taxes, so they'll have an opportunity to write off more of their payment every month. As well as mortgage insurance is going to be deductible again now, and a couple other things. So I'd say the biggest change right now is we're probably going to, for the first time buyer and for the moderate income buyer, they potentially can see some real tax benefit that they weren't able to see over the last couple of years, especially. So I would encourage people to, if they want to, if they're thinking about buying, take a look at that. Talk to somebody who might be a tax professional about what kind of benefit. Because if you have a $200 a month tax benefit, say that, it essentially reduces your payment by that much because you're going to get that much money back. So it's these are real numbers, and there can be some real savings for people on those.
Excellent. And thank you so much, Dave. Okay, and what's the best way for buyers to reach you?
You know, I of course have an email address, DDUTY at smprate.com, but I think give me a call or send me a text. It's just much easier to have a back and forth conversation about what someone's situation is. I'm very low pressure, never going to push people to do something they don't want to do. And if they're just wondering how it works or what they might be able to qualify for, a lot of times we can have a conversation and get a preliminary idea, so it can make sense. Yeah, maybe you should apply now, maybe you should wait. Maybe you should do this on your credit to help that out. So I think the sooner somebody contacts me and my team, the better we can prepare them for the process when they're ready to buy, whether it's now or whether it's down the road in the future.
Excellent. Thank you again for joining me today. And thank you all for watching. And don't forget to like, share, and subscribe for more real estate tips. And be happy. Thank you.
Thank you.